Well, that's right. The stock had a dream run. In fact, from the lows that we saw, the stock moved from around 100 rupees all the way to around 600 rupees odd. So it did have a big run. It was up nearly around 600%. We had alerted our viewers on Midcap Mania as well that, the business cycle was changing out there. But remember, from the top, it did see a correction. In fact, it was admitted to the ASM. And from there onwards, it's rallied nearly around 30%. It went to around 340 rupees odd. From there, it did see a bit of a bounce. But before getting admitted to the ASM, it had corrected already around 20% odd. Remember, the fundamentals of the business did change quite a bit. So, it produces iron ore pellets, billets, as well as steel products on the whole. And also, they have captive iron ore mines. Those were ramping up, and coal linkages as well were really increasing. The business had staged a dramatic recovery in the last financial year itself. So their capacity utilization levels did move higher. They were moving up the value chain, and raw material integration did start flowing in. And that's what led to a big turnaround in FY19. If you just pull up the profitability chart of them, you'll see that there was some deleveraging, and the profitability as well did come back in FY19 itself. So that's the profit number. Last year, they delivered a profit of around 200 crores odd. How did this happen really? Let's pull up the next chart and let's tell you exactly how did this happen. The pellet prices moved from around 4,000 rupees all the way to around 6,000 rupees. So that did help them for sure. Their output costs, what they're selling, those costs did go up. In fact, and if you just look at it, their raw material integration as well did improve. So the sourcing of iron ore, it moved from around 20% all the way to around 80%. So we should get that chart as well up for you. Coal linkages as well did improve. So the output costs are going up. Input integration as well was progressing quite well. And that's what really helped their business going ahead. Well, if you look at the triggers then, what are the triggers going ahead? The net debt to equity as well, that's improved. From around 3 times, it moved to around 2 times odd. The ROC as well improved from around 4% to around 17% odd. And there was some debt reduction as well with, improvement in their credit rating. In fact, it improved from junk rating to investment rating. And that's what's going to help them going ahead. Because can they refinance some of that debt that they've taken? That's going to be very, very important. ROC as well did improve. If you pull up the valuation picture then, how does it look? They did around 600 crores last year. The enterprise value, as of now, is nearly around 3,600 crores odd. So let's get that up for you. So it's trading at around 6 times EV upon EBITDA. What are the triggers going ahead? Sustenance of this EBITDA number. Can the 600 crores move to around 700 crores or 800 crores? That's point number 1. The second point is they reduced debt by around 100 crores last year. Can they continue with their debt reduction? The management had told us here on CNBC TV18 that they're looking at reducing the debt by around 250 crores odd. So those are the crucial triggers. Then, in fact, that valuation matrix that's currently at around 6 times EV upon EBITDA, it could appear a little more attractive. It's had a dream run. Let's see where it goes from here.